Good morning, everyone, and thanks for joining us for another round of our short fund manager interviews. We are joined today by Evan from Sesfikile Capital. Now, they manage run quite a few or run building block property portfolios for us. We include their funds in quite a few of the NAVIGA portfolios, and they've delivered very well for us, got a very strong track record. So thanks, Evan. Thanks for joining us. I'm going to go straight into it, into my first question for you today. Now, we've seen quite a dramatic increase in interest rates over the past year, and we know higher rates typically have a negative effect on property values, and it increases the borrowing costs, etc. So just maybe from your side, what has been the impact and the risk of the current higher interest rate environment, and what's your view going forward?
Okay, so it's a great question because out of all the headwinds, this is one that's probably a more sustainable headwind going forward, and it's something of concern across both balance sheet and income statement. So on the income statement side, within the South African environment, and really the focus of a lot of the even offshore stocks we look at within the SA index, a lot of them have managed through COVID to reduce their loan to value, so they're not overextended on their balance sheet. And also we've done several exercises to see if they had to refinance at current levels, what the impact would be. We see very little chance of, in fact, exceptionally little chance of any defaults or any, issues to the sustainability or the going concerns of the company. However, there will be some headwinds with regards to earnings in the shorter term, but nothing significant, nothing that will really change the investment thesis, because it is just normalizing to a normalized interest rates environment. So that is one thing that isn't too much of a concern for us. The other thing is that you've got to ask yourself, what is the reason or the justification for a high interest rate environment globally? It's because inflation's on the up. And inflation is generally good because it drives higher rentals across the board, especially in some of our Western and Eastern European exposures. We've seen circa 7-8% growth in rentals, where for many years it's been an inflation benign environment. So we see no increases in the ongoing rentals. So this is actually a great tailwind for us there as well. Overall, it's probably more of a little bit of a headwind than a tailwind, but you are seeing the commensurate growth in rentals, coupled with a higher interest rate environment. But as I said, most of these balance sheets are well hedged, and you're not going to see the big impact coming in straight away. Over and above that, we are seeing potentially some normalization or slowdown in the increased or the increasing from the Fed. So if they take a bit of a breather and slow down as they want to avoid recession, we do believe we're probably coming to the end of the consistent increases in rates, and we might kind of sit at those levels for a year or so, and then potentially seeing cuts going forward. So that's some good news ahead as well. Also, over and above that is the long bond yields. So this isn't as it pertains to the cost of funding, but more so to the valuations. The higher the bond yield, the higher the opportunity cost of investing in property. But the benefit of that is that property still has an element of growth there, so you can still justify those relative yields. And at the moment, our sector is still trading at a discount, meaning that it is giving you a higher yield relative to the weighted average bond yields that we have exposure to.
All right, yeah, that's clears it up well. Thank you. Give a bit of different perspective as well to think about the reasoning behind the interest rates, and then also looking through to those bond yields. Maybe onto another headwind, a big one locally for South Africa, is the impact of load shedding. We know obviously load shedding has a significant impact on operations and the costs for tenants. So maybe just how have you guys been managing this risk, and how do you see it playing out?
The first time I started putting together presentations for load shedding was 2008. So this is nothing new for us. Obviously, it is a significantly more of an impact now that we on stage 6 and higher. So it is a concern. It's something we have to deal with on an ongoing basis. There's a few things to take into account here. Is that firstly, the index that we follow, which is the ALLP, the All Property Index, 48% of the see-through asset exposure is actually global, so it has no impact by Eskom. And over and above that is that even within the South African exposure, the likes of logistics as well as storage has less of an impact, or is less impacted by the likes of load shedding. However, even though that they're not impacted operationally to the same extent, we got to understand that it is a huge, call it negative sentiments across the country. And with that said, is that it has an impact both on balance sheets and on income statements. On the income statements, we've seen that the cost of operating a generator is 4 times that of getting money from Eskom. Well, sorry, getting power from Eskom. You don't get money from Eskom. So it is a lot more inefficient. And what we're seeing, on the positive side is that over the years, I think that, well, it's not really positive. There's a lack of trust and reliance on anything linked from a government perspective or municipal perspective. So a lot of the guys have diversified into solar and battery solutions, and you started to see that accelerate in a big way. Also, as Cyril's enabled them to go beyond the 1 megawatt production line, and you're seeing a lot of these guys coming through in a significant way. So they are producing power, or they got solutions to generate power at an average cost of, call it, 2 Rand a kilowatt hour, as opposed to what they're paying Eskom, which is north of 4.20. So there are some savings costs there, and no less of a reliance on the parastatal. So that is a positive. But the way we're taking it, yes, unfortunately, it is going to have an impact on earnings, and we're putting those into our models. So we are forecasting for lower growths. On that side, we're forecasting for, unfortunately, more strained tenancy on the grounds. But what we also are looking for is, maximum pessimism. So we do believe that with the inflow of private generation of electricity coming through, we believe that this winter will really be the peak of the crisis. And should we not see a grid failure, but just significant load shedding, we do believe that should ease into the end of the year and into next year as well, into a much more sustainable environment. And if we start picking up or reverting from some of the offshore exposures into some of their more SA-focused assets at reasonable or very attractive pricing, we do believe we can ride that wave on the up as well.
Okay, thank you. Maybe on the topic of attractive pricing, we know valuations are very attractive kind of across the board. There's big discounts to NAV, and yields are strong yields on offer. But with a very low growth prospect for South Africa specifically, maybe globally as well, what are the opportunities that you're seeing, and what's the potential catalyst for those opportunities?
Okay, so the growth prospects globally are better than ours locally at the moment. But again, we are seeing that, or we're expecting it to improve. But there is growth, albeit 2-3%, but we are seeing growth in earnings off a very low base. So our distributable earnings yield is effectively, call it 11.5%, whereas the actual distribution paid is just over, call it 9.3% at the moment as we stand. So there is some growth, but off a very attractive base. So we're seeing a nice cash flow going through. We've had many headwinds in recent times, and one that's not many are aware of is the change in Regulation 28, where pension funds were allowed to go from 30% offshore exposure to 45%. And that we've seen across all the asset classes in South Africa is a sell-off in SA Inc. into these offshore exposures, and it's been a big impact when money has been flowing out, not because of earnings prospects or valuations, just to rebel and go offshore in line with the changes in Reg 28 or to the maximums. So once that has slowed down, and once we see some sort of normality, or I think more so reliance on the grid, albeit a low reliance, and there's a view that the grid will hold firm going into the next 12 months and beyond. And as that private electricity comes through, and really you can operate in a normal manner, I think people will all of a sudden start to recognize the deep value that was created in that moment of pessimism, and you'll see cash flow back, or even it doesn't have to flow back, but it flows out less than it has been as that change in Reg 28 has occurred. I think you'll see a nice correction in the listed property environment, barring a grid collapse, which that correction should take longer.
Okay, perfect. Evan, thank you so much. That's all the time we have for today, but thank you so much, and thanks for everyone who joined us. Thanks.
Thank you for the opportunity. Goodbye.